Hello, on today's edition of the Final Bar, we're going to do our normal Friday Wrap the Week segment where we look at today's price action, connect it to the week's movements, and then broaden that out to the broader, longer-term investment trends. We're also going to answer your questions from the viewer mailbag on secular bear markets, on auto sizing or charts, on a number of other key topics, and a nice continued up move on a strong earnings week. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining us today and every weekday as we unpack the trading day from a technical perspective, connect it to the long-term trends, put you in a position to understand how the charts can help you visualize probabilistic outcomes and get a good sense of where things might be headed. Think about it relative to your own investing. Today we have a bit of a continual follow-through. I think that's been the theme for this week. Heavy earnings week, lots of rumors of the U.S.-China deal and so forth. But in the end, the market just continues higher. And if there's one thing I hope you take away from all of our discussion about charting on the show is that a consistent pattern of higher highs and higher lows means the market's going higher. And until you see some sort of divergence from that, the trend is positive. Before we get to our market recap, I did want to share with you some of the events we have coming up. Next week, on January 21st, I'll have Greg Schnell. On January 22nd, Greg Harmon from Dragonfly Capital. Also on January 22nd, we have the 2020 Market Outlook, where a number of my StockCharts contributors are going to be sharing our take on the market environment for the year. After that, on January 27th, Mark Ungewitter, and then on January 29th, 50 Years on Wall Street. This is our special documentary interview with Ralph Acampora, highlighting his 50 years on Wall Street based on a visit we had with him in Minnesota last year. So you're not going to want to miss that on January 29th. So a lot of really interesting things coming on StockCharts TV, but let's get to our market recap. So as we've talked about, I mean, this pattern, this continual, unabated uptrend in stocks just it seems to have no end in sight. And every time that I've tried to highlight potential issues, potential red flags, the market has sort of shrugged them off and gone higher. So, I think it was our guest yesterday, maybe 2 days ago. I think it was Katie Stockton, maybe talking about price and how price is most important. Remember, all the rumors, all the news, all the headlines mean nothing relative to the price. The price is what tells you what is happening. And Ralph Acampora, who I mentioned with the documentary coming up, he always says you can't restate price. You can restate fundamentals, you can restate news headlines and change the way things are coming out. You cannot change price. Price is something transacted at a price at a certain time, and that is pretty much set. So following the trends, following the momentum is so important. So let's look in this recap through what's happened today, and then we're going to wrap the week, sort of look a little bigger picture on it. So the S&P 500 closing above 3320 today, almost a gap up here, closing in a position of strength, just below 3330, which is another new price high, new closing high. The RSI has gotten to 76.5. And again, sort of the shorthand for me is an RSI above 80 is that extreme overbought level, which we were getting very, very close to. What's happened this week, if you look at it, we have this bearish divergence, this non-confirmation, but look at how the last couple days have sort of negated that, right? So if you get a break in that divergence, it sort of confirms that there's further upside. So at this point, boy, stocks are pointing to higher highs, higher lows, continual uptrend. The trend is higher. Any pullback 3210 I think is going to be pretty key. The 50-day moving average has been rising and is almost right about to that level. So I think that'll end up being a key line in the sand if and when we get some sort of meaningful pullback, which, boy, if you ask anyone that has invested for many time in their lives, will tell you the market is overdue for a correction. But again, let's follow the trends primarily. In terms of how things played out, the S&P 500 ended up rallying into the close, putting it up just over 1/3% today. Small caps and mid caps actually noticeably were down today, so it was very much a large mega cap driven continuation rally. Other indexes kind of closing lower. So, potential divergence there, potential disagreement between the large and then the smaller size of the market. Looking at sector returns today, communication services #1, followed by utilities, followed by technology. So we've had this situation here while, tech remains at the top of the list, totally fair. Communication services, a lot of offense in there, totally fair. But then you have utilities. So we've had utilities and or real estate up toward the top of the list most days this week, I feel like, which is unusual. That is not sort of the traditional, foot on the accelerator going higher. That's more of a defensive play, more of a yield play. So kind of an interesting disagreement. Again, we've got a lot of earnings flowing around. There's a lot of potential catalysts, but that's certainly what things are aiming at there. At the bottom of the list, you had energy down again. And again, boy, if I would encourage you to not be thinking about energy as a long idea until you get some sort of confirmation, especially on a relative basis. So, as of this week, energy made a new 52-week low in relative strength. The price is well above a 52-week low, but look at the relative strength that has gone down. So even though the price is holding up, even though it's found support around 59, potential interesting support level, boy, the relative strength is what's absolutely killed you. So even if you're right on the price, you're not really getting paid on a relative basis. There are better, prettier places in the market to be looking at. Interesting with energy as it does sell off. You're looking at the RSI. The last time, again, in a bullish phase, the RSI hitting 40, lined up with the bottom that we had last month at the beginning of December. So we may be lining up for a similar type of pattern. That's what I'd be looking for. That's what I'd be looking for there. Other big themes that we've talked about this week, just to highlight and where things have played out. Financials jumped up a little bit again, not the strongest place, but not the weakest place in the market today. But overall, again, threatening a new 52-week closing high. It was a little higher there at the beginning of the year, but very, very close. Back in a position of strength. RSI in a bullish phase. Relative strength has been down. And again, when we talked about financials, we also looked at this chart yesterday. This was a mystery chart yesterday, if I remember right. Nope, not XRE, KRE, which is the retail bank ETF. This is one that's pulled back to the 50-day, bounced up, a little bit of a down move today, sold off into the close, but overall still holding above support in the form of price support, the 50-day moving average with the RSI around 40. Relative strength had gone down there as well. So if you find support, if you find something like this, finding support in an upward sloping 50-day, that's usually what happens in a bullish phase. So financials, potentially an interesting point here, a little more in a position of relative weakness, but pulling back to what you'd characterize as a sort of a buyable level. I also wanted to look at the railroad index. So you had a lot of earnings this week. And again, I'm often asked, what do you do with charts relative to earnings, right? Is it really a good time to be looking at charts? Because earnings are what are driving things. I would tell you it is one of the most important times because you are measuring how investors are reacting to earnings, because it's all about expectations and then their expectations after the earnings release. So leading up to and after. And if you're not familiar with that, Tom Boley and John Hopkins over at Earnings Beats do a really good job of explaining this in the short term. But I would tell you a lot of the railroads reported this week. I see a chart that is this nice basing pattern. It's broken to new highs. RSI's overbought, relative strength starting to turn up. It's really emerging in a position of strength. And railroads had been relatively weak for, much of last year over the summer months. So, really starting to rotate, potentially, going to new highs and potentially starting to improve. So potentially a pocket to be looking at there. That is our market recap for today. I would like to move right into our next segment, which is to wrap the week. Fridays are my favorite day to do the show, I think, because wrapping the week is what's most important, because it is intentionally stepping back from the noise of the market, stepping back from all the flickering ticks of the day-to-day activity, which is where we have to live a lot of the time, and really focusing on the big picture. So what I like to do is a couple things when we do the wrap the week. Number one, I like to spend time with the Mindful Investor chart list. This is a long-term sort of oriented chart list looking at all the key charts that I use as part of my regular weekly routine to really understand what's happening and make a sense of where things are at. And in the morning, as part of my morning coffee routine, I look at this as well. We're also going to look at the relative rotation graph, think about sector rotations. We're going to look at what ETFs, what sectors, what industries have moved on the scooter rankings. Before we get to any of that, though, I did want to look over at sentiment. So I have a list of sentiment indicators. We're going to go down to the AAII rating. So, the AAII, it's a sentiment ranking. So it's basically looking at the bullish and bearish respondents. These are individual investors talking about what they think about stocks going forward. there's an interesting jump. This actually comes out on Thursday, so it came out yesterday. And the last 4 weeks, we'd sort of seen this pattern of less and less bulls, more and more bears. And as of last week's read, the number of bears and bulls were almost identical. It was just around 32%. So overall, it was pretty even on people being on both sides of it. This week has completely reversed that trend, and we've seen one more time an influx of bullishness. So we gained about 30% of the read here. So the number of bullish respondents went from 32% up to almost 42%. The number of bears reduced from around 32 to around 27. So certainly more, people leaning more on the offensive side, leaning more towards bullish. 4 out of 10 respondents saying the market's more bullish for the next 6 months. So a bit of a rotation there. That had been an interesting divergence of less and less bulls as the market went higher. That seems to has resolved to the upside, showing that there's more, plenty of bullishness from the retail investors. Let's look at the mindful investor chart list. And again, there's a reason why the first chart on this page is looking at a very long-term view of the S&P. This is looking at a 5-year weekly view with some long-term exponential moving averages, the PPO based on the 21 and 34-week exponential moving averages, and then the weekly PPO or the weekly MACD. All of these are sort of long and strong, up and to the right. The market is in a healthy position. A chart similar to this is the first chart I look at every morning, and if you're a long-term investor, I would encourage you to look at something like this first thing before you look at any of the other noise telling you about short-term fluctuations. Pay attention to the long-term trend, which remains positive. In terms of breadth, interesting this week to see all the cumulative advanced decline lines ramp higher. And you can see one of the things we've talked about is this disagreement with large and mega caps going up, but then mid caps, small caps not confirming. All of them have confirmed to the upside this week. So this move to new highs overall has resolved breadth in a more bullish direction. All of these are in the green by my read. Feels very constructive. Also look at the number of new highs. It's something we started to look at earlier in the week where we saw, and I know at the end of last week, potentially this increase in new lows on the New York Stock Exchange. Those have all eventually evaporated here this week, and we've seen more and more new highs as these lines have gone higher on both the New York Stock Exchange and the S&P 500. Interesting to see a pretty extended read on breadth in the form of the percent of stocks above the 200-day moving average. Again, this is in literally, pun intended, uncharted territory. This is the highest reading you've had in years and years. The only other times it's been this high, up above 85% from what I've seen, is back before this, earlier on in the secular bull market, 2011, 2012 sort of years when you had a nice run higher. So overall, fairly constructive there as well. Some other themes to look at. Semiconductors are often sort of a tell for the market. When semiconductors are outperforming, that tends to be a good thing for the overall market environment. You can see as the S&P 500 has been going higher, semiconductors have actually been lagging a little bit because other parts in tech, other parts of the industry, of the sector rotation have moved upwards more strongly than semiconductors. But overall, still in a consistent uptrend, higher highs and higher lows. Similar pullback to what we saw in November before it resolved higher. So overall confirming sort of a step on the gas type of environment. Interesting to note the momentum factor is improving. This is something that had been underperforming, which is kind of a strange juxtaposition. How can the market be going higher, but momentum names aren't working? And again, it's all about the calculation of the momentum factor, what stocks are included in here. But essentially, this is betting on stocks that have been in positive uptrends and assuming that that will continue. And you can see that that's actually reversed higher. So far year to date, even though that was a group that underperformed in September and October, this is coming out of the market pullback in last August. Year to date, this has actually recovered very nicely and suggesting that momentum is working just fine. This is the relative performance of small versus large. You can see this still remains very muted. So even though the breadth characteristics on small and mid caps have improved, on a relative basis, you're still not getting paid for going down the cap spectrum. It's still the largest mega cap names that are driving things. And with growth versus value, we looked at this earlier in the week, I want to say, but growth continues to outperform in a big way. So there'd been this period earlier last year where it felt like the growth trade was kind of over. You felt this rotation more toward value. But look at how that ratio has just come like gangbusters going to new highs. This is the pure growth versus pure value ETFs as well, also resolving to the upside. So overall suggesting you remain more with growth over value. Last chart I want to show on here, and then I want to get to some of the movers and the scooter rankings. This is looking at the U.S. versus the rest of the world, and I am keenly looking for themes like this that I think will catch people off guards. And potential themes that could emerge would be outperformance by energy. I don't think anyone is really expecting that. The underperformance of the U.S. versus the rest of the world. My guest on Wednesday, I want to say, Katie Stockton, talked about, she showed this a different way. She was showing the relative performance of EM versus the S&P and EFA versus the S&P. This is sort of the inverse of that, showing the U.S. versus the rest of the world. But at some point, this ratio rolls lower. It has not happened. You continue to see a move more toward the U.S. So again, as an American-based investor, it still pays to stay close to home. Let's finish off by looking at some of the scooter rankings. So we're going to go here to the member dashboard. We're going to go to charts and tools. We're going to go to scooter reports. We just have a minute left. I feel like the wrap of the week could be an entire segment. So someday we'll figure that out. But let's look at the industries that have been on the move. Change. So the industries that were up the most this week in utilities, I want to say the water index, in healthcare, medical supplies. You can see some really interesting groups being represented. There's industrials, there are materials, gold miners, up 28 points in the scooter rankings. That's a big transition from being one of the weaker groups. Materials have been sort of a forget about it sort of sector, but you can see gold miners, mining index, all some of the biggest movers to the upside. Also a lot of home-related, home construction, home improvement, retail. Number ties have been up there as well as some real estate. On the downside, you have some of the financials. You have banks, you have fixed line telecoms, that's AT&T, Verizon, tobacco, broadline retailers. So there are a number of spots. What concerns me are some of these financial sector, banks, asset managers, all some of the worst performers this week using the scooter rankings. That's all the time we have for that one, but I'd encourage you to spend more time with the scooter reports. Look at the 1 week change, also on individual names. You'll find some stocks that have moved you that you might not be as aware of as you should. Folks, we're going to take a quick commercial break. We'll be back opening up the Final Bar Mailbag. We'll see you in a minute.
I'm going to tell you when the next bear market is going to begin. There will be a bear market, and it's going to begin and get really bad when we enter a recession. So the secret of staying out of bear markets is to watch out for recessions. If you can predict a recession or know that we're entering a recession, that's when you get out of stocks. Other than that, you really want to be a long-term investor. The long-term trend of stocks is up, except for when we have recessions. So recessions, huge impact on stocks. So watch out for them. Your trading, your investing will be so much better.
Hello, everyone. Welcome back to today's edition of the Final Bar. I'm your host, Dave Keller from StockCharts. Really appreciate you joining me every weekday on the show here. We are going to open up the Final Bar Mailbag. Really appreciate all your questions coming to us. And reminder, you can get to them a couple ways. Email us at thefinalbar@stockcharts.com. You can get us on Twitter at FinalBarSCTV, or get to us on the Q&A segment during the show. We'll capture all of those. We'll review them and make sure we address some of your questions going forward. The first question came from the chat room earlier this week. Is today an example of buy the rumor, sell the news? And that's such a really good question. I actually didn't say it that way, and I think this was Wednesday. This was whenever the day came out with the U.S.-China negotiation, the big signing. All right, we've hit a resolution. We're going forward. And what happens to the market afterwards? And I think this is what that question was getting to. It's just an example of where you buy the rumor. Buy when there's a rumor that there might be something brewing between the U.S. and China, and then sell when it finally plays out. That is where this comes from. And you can see, one of the challenges when a new headline comes out with the U.S.-China relationships, you can tell, in my opinion, it's how much of that, and I think this is what I said, how much of that is already baked into the price, right? So when the market expects something, when investors expect something, they start buying, expecting this U.S.-China relationship to improve, or the tariff deal to be signed in some way. And then it's all about what happens relative to those expectations. At some point, there's no further upside that can really propel the market farther because all the buying has already been done. Everyone's already expecting this. They're now expecting that to happen. They're just waiting for the final signing of the papers. And so all the buyers are already in the market. So once the final news actually comes out, there's no one left to propel the market higher. Now, again, that is not a statistically significant explanation I just gave you. It's way more anecdotal. And it comes to mind when we spent time on the New York Stock Exchange floor with Jay Woods. A Trump tweet came out when we were on the floor of the exchange, and we talked to him about it. And this is in a shorter term experience. This is sort of what we're talking about here. It's all about expectations, and at some point, you can no longer use that as a potential catalyst for upside. I would also point out, and thanks for that question, I would also point out that, remember, we always love to try to attribute a reason for why things happen. The stocks are up because of a tweet or because of an agreement. Stocks are down because of inflation fears or earnings or whatever. Sometimes stocks just move because they move, and that's why I think charts are so important. It orients you to the price itself. So thanks so much for that question. Buying the rumor, selling the news. I think that's pretty much the case. And again, you wonder how much more upside we could get from further headlines related to what's already come out related to U.S. and China. Second question. Let's see. Would you mind speaking to the concept of the path of least resistance? I was looking at the 10-year yield yesterday. One of the investors I follow on Twitter spoke about the TNX, that's the 10-year yield index, and said the path of least resistance is down. I agree with his sentiment, but I've had trouble grasping that concept. I'm sort of summarizing just for the sake of time, but thank you so much for that question. Let me get to the chart of the 10-year yield, and I'll explain what I think you're getting at. And so, a lot of times there are different ways, different shorthand ways that we talk about where a market expectation is, what we might expect the market to do based on, history, right? And again, I think the whole discipline of technical analysis is basing on the fact that the market doesn't repeat itself, it often rhymes. So if you can look at market history, see how investors have reacted to similar environments, using the charts, you can get a sense of what should happen, a probabilistic outcome. It's never a certain outcome, but a probable outcome based on the combination of factors and how it relates to previous times. When the commentator, I would guess, and again, not putting words in his mouth, or her mouth, but just thinking about what they might have been getting at, a lot of times you'll talk about that probabilistic outcome based on what we've seen, based on the environment, based on inflation, based on the Fed, based on whatever things they might be looking at. The path of least resistance, meaning the most probable move in their opinion, would be a downward move in rates based on the fact that you have an accommodative Fed. And again, I'm just guessing what they might be thinking based on the economic environment, based on unemployment, based on inflation, based on the president, whatever it is. Overall, I'm expecting the yields to go down, expecting bonds to rally. And so that would be the path of least resistance. We often talk in a different way. We will often talk about the pain trade, which is a similar sort of thing. Walter Deemer reminded me of the quote that the market will often move in the way that will cause the most amount of pain to the most investors possible. A number of market practitioners over the years have shared some version of that sentiment. And we always talk about the pain trade. So, certain things, not necessarily an expected move, a path of least resistance, but what move would cause the most pain to the most people? For me, a potential pain trade would be an underperformance of the U.S. versus the rest of the world. That was a chart we looked at earlier. And again, it would be a pain trade because you would be caught on the wrong side of that. You would have to get in there because all of a sudden it would be a very painful experience. That would cause an influx of people, and all of a sudden the new path of least resistance would be where that headed. So in my opinion, that's probably what they were getting at, and I don't really use that phrase, path of least resistance, but in general, it's a recognition that trends occur, that the market moves in trends, and based on the combination of factors, that's sort of the expectation. I usually will say that's my base case. The base case would be lower rates because that's what you'd expect based on what you've seen before. Great question, and thanks for that one. Third question is a little more technical using the StockCharts platform. It was looking at auto-size charts. Could you briefly discuss the operation of the auto-size charts feature selection above the upper right of each chart? And I'll show you what they're getting at. If you look at a chart and you look at like 10 per page or view all, depending on what screen you're looking at, you'll see this beautiful, this is how I look at most of my chart lists, as you probably know, this in Candle Glance, because it just gives you vertically, it's very easy to just scroll through a bunch of charts and see what you think. Up here, you can see where it says auto-sized charts. What is that actually doing? Well, I'm gonna just butcher my chart list momentarily. Let's say I make this chart ridiculously big, which I don't usually do because as you can see, it goes off the viewable area. So I basically made this chart of Apple ridiculously big. It goes way off here to the right. You can't even see the whole thing. And I've got a pretty big monitor that I'm doing this on. What happens when I go back to that 10 per page, you can see by auto-sizing it, it shrinks it down to fit the monitor. If I take off auto size chart, I'm going to get that way too big chart. So if you tend to look at really big charts and you're looking at a smaller monitor, that is where that's going to come. 99% of the time, I'd suggest you just leave that on, because all it's going to do is auto scale really big charts so that you can see. So you can see the resolution of this chart is actually huge, and it's just bringing it down a little bit. It's just sizing down the image so that I can scroll along with all my regular size charts and it doesn't get in the way. All right, so that is auto size chart. The only place I think you really see that is on the 10 per page or the view all mode, which gives you sort of this scrolling through the charts kind of feel, and that's why you want to select that option there. So thanks so much for that question via email. Final one, is there a good graphic for a secular bear market? Interesting question. Again, it's tough to know exactly what you're looking for there, but I will tell you a couple things. Absolutely. I think there are great ways to sort of visualize bull and bear cycles. One of the things that I would definitely suggest to you is on StockCharts, click on Charts and Tools. One of the underappreciated parts of the platform is this historical chart gallery. These are fantastic. You can see history on the presidential cycle, long-term market breadth, long-term valuations. But if you go to the top important market indexes, go down here to the S&P 500, this is the way you can see these secular bull and bear cycles. So this is the secular bear market coming out of the Great Depression, the bull market in the 50s and 60s, the go-go years is what you called this. The 1970s, right about here, 1968, I want to say, is when Ralph Acampora started his career in the financial industry. So again, it's coming up later this month, our 50 years on Wall Street with Ralph. This is the secular bear market he started in, the bull market of the 80s, 90s, the bear market that we had in the early 2000s, and now the secular bull that arguably we are in now. So the long term, when you're talking about secular bull and bear markets, these are multiple decade patterns, and you need to look at a ton of history. And so I would point you to that historical chart gallery, which is a really good start point. If you haven't dug into some of that deep history, boy, do yourself a favor and learn some of those long-term lessons. Folks, thanks so much for those questions. We need to turn the show down by going to the 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar yet, they should be as of this moment. Our first chart heading into the weekend, these are all sort of big picture charts, sort of the mood I was in as I was preparing our Wrap the Week segment. The first one is a breadth by cap tiers. So again, you can tell by the way I talk about the markets, talk about the charts, I am recognizing the fact that we're in a consistent uptrend that is undeniable. I am always looking for potential red flags, things that might tell me why to disagree with that. And I'll tell you, when I worked at a large buy-side institution, I loved the fact that we could have bull-bear debates. We would have someone that would be the devil's advocate, you know, the 10th man that would sort of take the opposite side and intentionally argue against what we all saw very obviously, because what you want to do is disconnect from your biases and look at what might disagree with your point of view. And so I'm always looking for red flags, but I tell you, one red flag that has completely dissipated is the cumulative breadth in the form of the cumulative advanced decline lines. And all across the board, these are all color-coded green because they have confirmed new highs through this weekend, and the market is in an uptrend across the board. The second one is the U.S. versus the world, and again, I'm very attuned to a potential pain trade. I think the path of least resistance, if that's how you'd want to describe it, is up. We continue to see U.S. strength. Every time this has come down a little bit, you've seen the ratio perform back to the upside, so telling you that the U.S. continues to be the place to be, and that's based on a lot of different things, based on the dollar, based on economic patterns, all of those things. But overall, as long as this ratio continues higher, the trend is positive, and you want to be leaning more toward the U.S. At some point, I think that's an important chart, because if and when it turns, you don't want to be caught on the wrong side of it. And then the third one is looking at stocks versus bonds. So this is the Spiders SPY versus the 10-year, the long bond ETF, TLT. This ratio overall has had some fits and starts, but the trend has been positive since mid-August. So again, thinking about diversifying away from stocks, going into bonds, getting the safety there, getting the yield, you're not getting paid for it. And that's what this chart is telling you. Until this rolls over, until you get a lower low, a break below support of this ratio, it's telling you to continue to stay on stocks versus bonds. So as an asset allocator, I think you want to continue to be foot on the gas, thinking of what's working versus what isn't on a relative basis. And that's why that is the third chart in the 3 in 3. And ladies and gentlemen, that is a wrap for today and a wrap for the week. I want to thank you so much for watching the Final Bar every weekday, 4 p.m. Eastern on StockCharts TV. You can see all of our previous shows on our YouTube channel. Go to YouTube, look for StockCharts. You'll see all of the episodes of the Final Bar along with all my other fellow hosts on StockCharts TV. Please keep your questions coming. The 4 questions today all came from you via email and via chat. the Final Bar at StockCharts.com. Have a great weekend from Redmond, Washington.